consistent. The primarily idea is to be consistent on a long-term basis, on a risk-adjusted return basis too. So don't take aggressive bets on either side where you're not able to manage it in the right proportion. So take measured bets and try and be really, really consistent over long term, as the case has been over the last 10 years since I've been managing the fund. So the basic philosophy is, primarily to look for value at reasonable valuations, basically growth at reasonable valuations, and be patient with your investments. So the way the fund works is we look at, I work more on a top-down basis. You look at global events, global interest rates, global demand, move down to India macro, and then go down to sectors, and then within sectors pick the stocks do you think are likely to do better in a upcycle. So that's the philosophy, that's the style in terms of the fund management, which is more top down. But of course we run our query modules, etc., wherein we make sure that we don't miss out anything from a bottoms up perspective as well. But simple basic philosophy is growth at reasonable valuations. Having said that, it's easy saying it, very difficult in a market like India, where we have lots of stocks which are very, very well established and pretty expensive in terms of valuations. Again, that doesn't mean we will not own these stocks. We will own them, but we will own them primarily because of a reason which could be huge entry barriers, some particular positive moats, some technical advantage vis-a-vis competition, first mover advantage, and many other things. But primarily it's a growth at reasonable valuations, I reiterate. Yes, we do look at it primarily because I'm, as a fund manager, my DNA is that I'm anchored to valuations, which means that for me, looking at free cash flows, looking at balance sheets is far, far more important than looking at a P&L. And why is that? Because it's free cash flows basically, and it's the balance sheet basically which will tell me where the risks lie, and how is the company doing on a sustainable continuous basis, and whether it's able to generate free cash flow which is reinvested probably back or given back to the shareholders. So that's the most important part that I look at, and that is why I have been leaning more towards value. Now within value also, it's not just that because the PE is cheap it becomes value. You also need to look at the fact whether the the majority shareholder, which could be the promoter, which could be the government, which could be anyone else, a private equity could be running a fund, whether their interest is aligning with mine, which is the minority shareholders. So it's not just plain mathematical cheap PE that makes it value. There has to be an alignment of interest where you really believe that the interests are aligning and the business deserves a better valuation than what it is trading at. I would definitely recommend this to be a part of core portfolio, and it should be easily 30-35% of one's equity allocations to mutual fund. And the reason being very simple, this is the only category wherein SEBI has given complete freedom to the fund manager to choose where he would like to invest within various market caps. And over the 10 years that I've been managing Birla Sun Life Equity, which is ABSL Equity, we've kept this large cap proportion constant between 65 to 75%, which means automatically the mid and small caps are between 35 to 25%, which means you're giving a flavor, you're also giving reasonable alpha, you're distinguishing yourself versus a mid cap which has 50% plus large mid caps, and you're distinguishing yourself differently from a large cap which has over 85-90% large caps. So, and over time, as you've seen in the last 10 years, that this really provides a lot of consistency to the fund's performance. It makes sure that the fund is not wobbly enough, and not basically moving too wildly or violently. And this is the philosophy that we've run the fund, and this is the philosophy where we will have large caps between 65 to 75% consistently. I would urge investors to look at a minimum of 3 to 5 years. This is what I give the companies and the managements in which I invest. I cannot judge a management or a company based on one cycle and one, but definitely not on a quarter and definitely not even on a year basis. Lots of things can go wrong, with companies. It's easy to sit on a spreadsheet and put the numbers, but for someone running a company as an entrepreneur, it's lots of challenges on a daily basis. And if I'm going to give a long rope to managements, okay, I would expect my unit holders and my people who are putting money in my scheme to give me a long rope to see through the whole cycle. It's important to see how managements react in good times, and it's important to see how they react in bad times. And that's why 3 to 5 years is a reasonable span of time, wherein you see probably both cycles occurring. I don't think that, I don't think any fund manager should honestly change his or her style, because you do best what you really believe in. And, it's the style which actually distinguishes a fund manager. And my DNA is, primarily anchored towards valuation. So I don't think one should really be changing style. And my observation has been that if you're rational and if you are anchored to valuation, you will eventually do really, really well. But there will be phases wherein markets could challenge you. Stick to your style, honestly. Absolutely important. Do not change your style in the middle of a cycle. You can lose both ways. Okay, so don't change your style. Two, equity investing is all about having a lot of patience. Okay, I think these two are the biggest learnings as far as I'm concerned. You need to be patient to see your story playing out, to see your thesis playing out. If you are early into exiting, okay, that's where the problem is. It's okay to be early in getting in, because it's only the time at times where you're earlier than the other investor to come in, and you're waiting it out, etc., and the stock is underperforming for that period. But eventually, if your stock pick is right, you will make up for that that underperformance for a short period of time. So in my philosophy, it's okay to be early to invest, but it's not okay to exit early. So that's, these are the three learnings if you ask me. Yes. So look, I think this year, will be a tough year, challenging year. Just too many events globally which are out of control, and it's the geopolitical situation, the COVID situation, inflation extremely high across the world, and obviously that hurts valuations as far as equities are concerned across the world. So it's going to be a challenging year, and it's fine to be a challenging year because we've had 2 great years, in terms of equity returns, particularly in India as well. So I think this year will be a challenging year to make money. But if you ask me from a 3 to 5 year perspective, I'm extremely excited on India. I think 10 years back, there were 7 or 8 emerging economies, which we used to call as emerging countries, and global funds were launched as emerging market funds. You had Russia, you had China, you had India, you had Turkey, you had Indonesia, you had Thailand. Today when you look across, each one is having their own serious problems, while India is like an oasis in the desert. We've fixed our foreign exchange reserves are strong. Our currency is reasonably stable. We've had lots of reforms over the years, GST, direct benefit transfers. You had, primarily these two were the big ones. You had 24/7 water, 24/7 power, which is coming through. And, the multiplier effect of all these things will see the country really moving ahead in the next 3 to 5 years. So pretty excited on equity investments from a, 3 to 5 year perspective. This year will be a year of accumulation, buying on dips primarily, and waiting out for the dust to settle, particularly the inflation issues to kind of settle down across the globe. I think, look, as I said before, inflation is definitely the biggest challenge the world is facing. Every central banker across is doing his best to kind of tame this inflation. I personally believe that inflation is partly because of the demand side, and globally, a lot of money printing happened, particularly in the Western world. People were given money to sit at home, and they've come back all with a vengeance and spending. But part of the inflation is also because of supply side issues, basically because of the Ukraine Russia war, because of China having a COVID policy of zero tolerance policy and hence shutting down production in many cities. I think we will over the year start seeing some of these supply side issues easing. You will see demand obviously coming off. You may see some of the Western countries going into a short recession possibly. But my understanding is that the central bankers, particularly the Western worlds, are married to the markets. They're not really married to economy, and they will do what it takes to bring the markets back. So not really too perturbed in the longer term. Yes, we will probably see inflation a little longer than most people would want to. But I keep saying, it's a buy on dips market. Don't be aggressive when you're buying. You will have, markets correcting and giving you opportunities in this year to buy. So from a longer term perspective, the way Flexicap's overweight positions are today, and that should tell you, what I'm really, excited and positive about, is, IT, while the stocks have corrected and we've just kind of gone overweight in recent times, they may be still higher on valuations, some of these companies given the past history, but I think they are fantastic cash flow machines. The world is looking to digitize, and this is a theme which will play out over the next 3 to 5 years, and India is right there to capitalize on this. So I'm, from a medium to longer term perspective, I'm very positive IT. I'm reasonably positive and more so on healthcare as a whole vertical, where I think valuations have come back to pre-COVID levels. They completely fit into the theme of growth at reasonable valuations. Again, some of the best managements the country has is in healthcare. We are the global generic provider to the world. These companies throw excellent free cash flow year after year and invest in various countries on their R&D, etc. So these are the two sectors. And the third sector, which one is really positive on a longer term, is the specialty chemical sector, where we are large overweight. Again, this year and the last couple of quarters has been challenging because of the raw material scenario where costs have gone up. But clearly we as a country have inherent advantage in chemicals. We have a legacy, we have a history, and I think you will see consistent 15 to 20% EBITDA growth in these companies over the next 3 to 5 years. And the stock correction should be used to buy into these. We are always alert and keep looking at where the risks lie. As I said, I think from the risk that I just articulated, we are pretty reasonably well positioned. At the same time, the portfolio is now reasonably getting aligned towards longer term capital appreciation, which India has to offer and Indian equity has to offer. Look, we have 7,000 plus odd stocks listed in India. I think we have enough choice in India. I really don't want to go abroad and invest too much. There could be a one-off here and there, which we'll look into, but I think India offers humongous opportunity. I'm quite happy and believe that over the next 3 to 5 years, India will really grow and will be and already we can see it's one of the rising stars in emerging markets, and I think the opportunities are going to be abundant in India to invest.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.